Good morning, everybody. Welcome. All right, who's joining us today for your real estate brokerage finances? We're going to talk about our favorite topic, which is the money. Woohoo! Who's excited to be here? Today is Wealthy Winning Wednesday. Now, if you take a look at the chat bar up at the top, I have some links for you there already. The first one is our Brokerage Mastermind group on Facebook. And join the group. That's where we're going to put all the replays, all the great bonuses, handouts, all these things that we've been sharing with you. You'll find them there. So go ahead and join the group. Secondly, we have for you a couple of things we're going to be talking about later today, but QuickBooks is on the agenda. And so we have a link to a QuickBooks training video series. And we're also going to be talking a little bit about taxes. So we have a tax library from a CPA and attorney who is going to be sharing some of that with us as well. So who's ready to get started? Woohoo! Go ahead and type into the chat bar as I go ahead and start our slide presentation here. Let's see what we have. Oh, hi, Karen. Karen Taylor is joining us this morning. Timothy, the Timothy King. Woohoo! Thanks for joining us. All right. Hey, everybody. Maramash, hello. Good morning. I see more people popping up. Michelle Stewart from Fort Worth, Texas. Welcome, everybody. Are you ready for some number crunching today? Okay, we're probably not going to do a lot of number crunching, but we're going to talk about it and talk about cash in your bank account, cash in your pocket, and cash flow. So let's get started. Sukita Duncan says hello. Fran from Katy, Texas. Good morning. And Latanya Martin, Nashville. Thanks for joining us. We have Marcel Romaine from Orlando, Florida. Kelly Foley. Hello, everybody. We're going to keep going here. This is session 3 of our 12-part series. This is step number 3, your finances. We're going to be very high level today. So welcome and thank you for taking some time out of your busy workday to join us to learn about these awesome Fortune 500 concepts without the MBA price tag. So we're going to share with you some things that you may have heard before or you may have heard about, and we're going to share them sort of at a high level. And if you have any questions, be sure to let us know. And if things that you see are not already in your business plan, we can help you get there. So a little bit about MBA Broker Consultants, and you probably know a little bit about us already, but we are a brokerage consulting firm and also leadership development. And we're here today to share all of this wonderful information that we have for you. Today's mastermind, as I said, it's the third of 12 steps. But most importantly, there will be an activity workbook that I'm going to download for you in a bit, and you'll also have some bonuses that I'll share with you at the end. And a little bit about me. I think everybody knows me by now since this is our third session, but I'm MBA degree as of last December. So all this information I'm sharing with you is fresh from the MBA program. And I'm broker owner of California Coast and Country Homes. I've been licensed for 30 years in California, and I'm passionate about serving our real estate industry. So earlier we learned about step 1, which is your vision, your dream. And then step 2 is take that vision, put it into a blueprint. And now that it's in a blueprint, we need some power tools to get started building our empire. And as you see in our little slide here, these are some pretty heavy duty power tools. So we're not talking about a jackhammer. We need some heavy equipment, right? So the financials, we're going to talk about forecast, formulas, and funding today. So today's agenda, we have 6 different topics about finances we're going to discuss. The first will be your financial statements, also known as the financials. Forecast versus budget. We hear those words thrown around a lot, but what is the difference? What do they really mean? We have some ratios for you. And don't worry, it's pretty easy math. We have bank accounts that we're going to show you an illustration of how to set up some bank accounts. We'll talk about bookkeeping, accounting, tax prep, and lastly, we're going to discuss raising capital funds, which is probably why some of us are here today. We'd like to find out about starting our business or expanding it. And to do that, you probably need some capital funding. So what's going to get you there? A business plan with a Pro-Forma, and let's get started. We hear a lot in real estate about production and volume and how many sales the agents made or how many sales our brokerage had. And it's good because production is king, as they say. However, the financials are the queen, and the queen wears the crown. That's right, the financials tell the true story of what's happening behind the scenes. So, who here loves math? Raise your hand, or you can type in the chat if you love math. Now, if you don't love math, it's okay. You will love math because if you just recognize that math means money. How do you calculate the money? With math. And guess what? You don't even have to bend your mind because you can use tools like QuickBooks, you can use Excel, and there's a lot of things that you can use to help you get the math down without having to do all those calculations manually, right? So our number one goal today is to maximize profits. That is the goal of every brokerage owner, is to maximize profits. But first you have to understand the math behind them. You have to understand the financials, the reports, make sense of it, and what they mean as far as what direction you're headed. Now let's just take a minute here, and I have a little myth buster for you. More revenue does not always mean more income. And I know in the real estate business, we're very focused on production. And for a brokerage, we also talk about revenue. My company had X amount of revenue, which is great. But if you're not making a profit or a big enough profit based on that revenue, then it doesn't really matter. The business is not a success. So we're going to talk more about that today when we bust the myth of revenue, production, versus the bottom line, your net profit, how much the owner gets, right? The owner's equity, which we're going to talk about on the balance statement. So financial statements is our first topic. And we have a little poll to get you started here. Let's put our poll up. Our poll is, which financial metric is most important? Is it A, production, B, revenue, or C, profit? So go ahead and answer the poll that we put up, and we'll see what everybody says here. Now, in our previous mastermind sessions, we had some polls, and in the polls, there were no right answers. It was basically finding out, gauging what our audience prefers. However, this poll is a little different because there is a correct answer. So let's see if everybody knows. So production is sales. For a sales-based organization, production is going out, making sales, closing transactions. Now, revenue is sales plus other sources of income. And as an example, revenue might include sales transactions, but it also may include income from a property management business or other streams of income, other profit centers that we're going to discuss next week. So between production and revenue, wouldn't you agree revenue is more important? But what is profit? Profit is you take the revenue, subtract all the expenses it took you to get there, and then that's your bottom line, the cash you put in your pocket, theoretically. So revenue is definitely more important. We're going to go ahead and end the poll here because everybody got 100% correct. Woohoo! So there we go. We are at 100% of everybody today said profit is most important, and you are absolutely correct. Profit is important because What would happen if you had, let's just use, for example, you're a flat fee-based brokerage, and you say, agents, you keep 100% of your commission. You just pay us a small flat fee. And then you find out when you actually go and look at your financials that your cost per agent is higher than the fees they're paying. So on every transaction, you're losing money. So you have a lot of revenue coming in, but you have more expenses than you have income, and that leads to a net loss instead of a net profit. So that's why the bottom line profit is the most important, and that's why we're here learning our financials today, right? Okay, so what are the most important financials? The three critical financial statements are your income statement, sometimes also known as a profit and loss, your cash flow statement, and your balance sheet. We're going to look at all three of those today. Also, we have our budgets and our forecasts. So the difference is a financial statement is historical, looking in the past, whereas a budget and a forecast is looking into the future and predicting or, hoping this is what your future is going to look like. And then three top ratios. There are many ratios used in financial calculations. We're going to share with you the top three and show you how to do those calculations. Okay. All right. So what would we say about direction? Your direction determines your destination. So the whole point of these financials is to show you what direction your business is going in. It may look like you're doing well because you have cash in the bank, or it may seem you're doing well because your production is great. But really, if you look at year-over-year production or production per agent or other ways that you can break it down, what direction is your business really going in? And is it going to sustain you long term? So the income statement. The income statement, sometimes we refer to it as a profit and loss. It's basically your revenue or income from all your sources and then your costs or your expenses. And there are two kinds of costs or expenses. We have fixed and we have variable. So fixed expenses are those overhead expenses that are going to occur regularly, regardless of whether you have any income in the company, whether you have any agents. So think, for example, your building. You probably lease your office. That's a fixed expense. It doesn't mean the payment is the same every month because it may vary depending on whether or not you have a net lease. Maybe you have a triple net lease, so you have more expenses some month. But it's a fixed expense because that overhead will always be there. What's another fixed expense? Your insurance, your E&O. What is another fixed expense? What about your salary, right? You want to get paid a monthly salary as a brokerage owner or manager. So think about those fixed. Now, variable expenses are those that go up and down. They vary according to your sales. So say, for example, every time you have an agent who makes a sale, you collect compensation and you pay that agent a certain percentage of it. That would be a variable expense, what you paid to the agent. And it varies, it goes up and down depending on the income that comes in. So every time you make a sale, it costs you money to make that sale, and those are your variable expenses. Does that make sense? Any questions? Let me know in the chat if you have any questions. Okay, what else? Gross revenue. That's your revenue from all sources, right? And then your gross income, which we're going to see in a minute. That's after some things are subtracted, like, for example, your returns. And then once your expenses are subtracted, you have your net income, and then you have which is your profit, but then you're going to do a little calculation and see what your profit margin is. And how do you know if it's good or bad? We'll talk about that in the next slide. Now, you may have heard the saying before if you watch Shark Tank, EBITDA. That stands for earnings before interest, taxes, depreciation, and amortization. So that is a net profit figure, but it means your profit before certain things are paid or calculations are completed. We just talked about your salary. Is your salary included? Is your salary in your financials more than if you were working at a potential job somewhere? Right? We talked about that in week 1. And also another thing the financials allow us to do are to compare dollar amounts and percentages year over year to let us know if we're on the right track, if we're getting better, getting worse, staying the same. And also we're going to common size those. We'll talk about those more. So any questions, be sure to let me know if you have any questions here. Here is a sample income statement. These are just some fictitious numbers for a brokerage that I put in here. So you can see at the top, there are multiple streams of revenue coming in. This brokerage is making money from sales transactions, referral fees, property management, agent desk fees, transaction management fees, consulting fees, BPO fees. All these account for their sales, right? There are different profit centers. They may have other ancillary services as well. So that number is 100%. That's their income. And then you have their cost of sales, which are, variable expenses. For example, what you pay to the agents, what you pay out in referral fees, or the portion of it. And we said in this case, say, for example, you're a 90-10 brokerage, or maybe 95-10 or a flat fee. You're paying out a lot to those agents. All right, you're paying out almost everything that comes in from the transactions. So in this we have for the example, your cost of sales is 90%, which leaves your gross margin only 10%, which is, pretty small. And then we have the variable expenses here. The fixed expenses, and $65,000 is the total there. So your net profit, look at the very bottom line there, before you even pay your taxes, is $35,000 a year, which is only a 3.5% margin. So that's itsy bitsy. And after you pay your taxes and your insurance, are you going to have money left for yourself? Maybe not. So we need to tweak this, and we need to find a way to make sure that you have more money coming into the bottom line, right? So that's just a sample income statement and how it works. By the way, it's all available in QuickBooks. So if you use QuickBooks, you can easily push a button and get these figures. Oh, as long as you have it set up, I guess I should say a little caveat, as long as you have it set up correctly, which we're going to talk about today as well. So, okay, so your balance sheet, what's on the balance sheet? Your balance sheet has 3 things: assets, liabilities, and equity. So assets are things you own. If you own your building, that's great. If not, that won't be on there, but your cash in the bank will be, your equipment. Your liabilities are things you owe. So if you purchased your office building, but you have a mortgage on it, the mortgage goes in the liabilities section. And the difference between the two, right, is your equity. So I said equity is great because that's what you actually own after all the theoretical bills are paid. So both sides must balance. I'll show you that in just a minute. And again, there's a way you can common size it or standardize it so you can compare year over year both dollar amounts and percentages and look for trends. That's the important thing, is to not just measure, but look for trends up, down, or stable. All right, so here's our little balance sheet. Okay, by the way, I'm going to go ahead and share with you mastermind activities number 3. So I'm sharing that right now. Go ahead and take a look if you can at the mastermind activities number 3. We have assets, liability, and equity there. So your assets are on the left, that's what you own. Liabilities are on the right, that's what you owe. And your equity is the difference between the two, and your equity and liabilities together add up to your assets. Okay, so that's going to be on the worksheet if you take a look at the worksheet. So we have a question here. Let's see. Timothy. Oh, okay. I saw a hand raised and it's not there anymore. So If you have something, go ahead and type it into the chat and we'll get to you. Any questions on the balance sheet? That's going to be on the little activities workbook I just shared with you. Okay, so the third document is our cash flow statement. Cash flow statement is really critical. As we said, this will be in your Proforma, and bankers or investors who are looking to fund your business or give you a loan, they're going to flip to that cash flow statement and see what it says, because they want to make sure they're getting a return of their money as well as a return on their money. So the cash flow statement tracks the flow of money. It's sort of like a bank account. It shows everything coming in and everything going out. And it's not necessarily the same as your income. A cash flow statement is a great way to spot dangerous trends that might be happening, signs and red flags, and again, to compare dollar amounts and percentages year over year and to common size or standardize those. Okay. Alrighty, so as we said before, the financials that we just reviewed, those are in the past. Those are things that already happened. Yes, they give us a trend. They show where we're going, but they don't show what's going to happen in the future. So how do we know what the future looks like? That's our next topic here. Amanda Ridgway says, hi, Regina. Hi, Amanda. How are you doing? The next topic is our budgets and forecasts. Okay, so budgets means what? Budgets are something that we put together that tells us where we want to be. That is included in your Proforma. Now, what is your Proforma? Your Proforma is your financials that go at the end of your business plan, right? And the Proforma is something that investors or bankers are going to look at and say, hey, we agree with this, we're going to fund the business. Or there's some flaws in the business, we're not sure that we're going to make money or even get our investment back, we're going to pass on it. So it's important to have a rock solid Proforma. A Proforma can show where your competitive advantage is for the business. It can show where profits are coming from, and a forecast also. So the Proforma is the appendix at the end. So let's keep going here because I want to talk about budget and forecast. So budget and forecast, they both are used for two things. They are financial planning techniques. They are tools to help you steer your business in the right direction, and they also help you make wise decisions. So you're probably going to be sitting down with your top team every quarter, looking at where you are versus where you want to be, and how do you steer the course to make sure that you're on the right track and that you're headed in the right direction, right? We already said direction determines destination. So a budget, it estimates or quantifies the expectation of revenues the business hopes to achieve for a future period. A budget is a plan for where the business wants to go. So your budget might say, we're going to make $1 million this year. Net income, right? Of course. Whereas a forecast is going to say, here's the path we're on. If we continue doing what we're doing, given the market forces that are out there, given our internal strengths and weaknesses, here's where we're going to end up based on the numbers. So it basically projects what's going to happen that's realistic. Not your big dreams. Maybe your budget is your big dreams, but your forecast is going to say, here's where we're already at, here's where we're likely to go. Okay, so that's a financial forecast. There, you can also forecast, sort of use it as a budget in other areas. So let's talk about that now. Oh, actually, we're going to talk about the master budget. So the master budget is usually done in a 12-month cycle. So you would be doing that right now to get ready for next year, right? Because your 12-month cycle starts most likely for most of us January. Our fiscal year is the same as our physical year, which is January 1st to December 31st. And so we're going to start our budgeting process in September, October, and create our budgets for next year. Now, there's not just one budget. A lot of us think a budget is the operating budget, but actually start to think big picture. You have a master budget, and under your master budget, there are other budgets that feed into that. For example, the operating budget, the sales budget, your expense budget, capital expenditures budget, and your cash or cash flow budget. So you can make sub-budgets, I guess you might call it, and each of those would feed into the master budget. So if you go and change something in a sub-budget, you can see how it's going to affect the overall business in the master budget. So any questions about budgets? They're actually easier than you think, probably. Okay, so budget types. The first one is a stretch budget. And I have that in parentheses because I wouldn't really call it an official budget. A stretch budget is where you're trying to challenge yourself and your team. You're challenging your leaders, challenging your agents and your staff to achieve goals that are bigger than maybe they thought they could do, right? So a stretch budget is giving you something that maybe you didn't achieve earlier, something to look forward to, and asking you to stretch your skills, stretch your sales, and do more, right? It's a challenge. So there are a couple of other types of budgets that we're not going to review today, but I'll just mention them. A static budget versus a rolling budget, which is pretty much what it says, a one-time budget versus a budget that's, being updated as you go, and a fixed budget versus a flexible budget. Okay, but I do want to talk about a variance report. So a lot of us know how we can go into QuickBooks, and when we're in QuickBooks, we can put a budget in, and then we could run our financials and see whether or not we met our budget and what percent we're over or under, dollar amount we're over or under. And that would be an example of a variance report of saying, here's what we planned, but here's what really happened. We plan to have $1 million profit, but here's what really happened. Here's the areas where we didn't meet our goals. And, here's how much we're off, either over or under. So that's a variance report. Okay, now let's talk about forecasting. Forecasting is not just for profits. You can forecast for other things as well. For example, you should forecast client demand. Who are your clients? Your clients are agents, but also buyers and sellers, right? You can forecast, look at the economy. Some people are saying the economy is, doing great. It's going to continue growing. Some people are predicting a market crash. Whichever way you predict or you forecast, you need to have some data to back that up. But you should look at not just the housing market, but other affiliated industries that impact the housing market. Okay, and then what about forecasting personnel? Not just your agents, but how many personnel you'll need at your company, what positions, what their salaries are going to be. Okay, any questions about forecasting? One of my favorite topics here. Okay, now that our minds are totally focused on these mathematical figures, let's talk about ratios. And again, that will be on your file that's being shared right now, the Mastermind Activities number 3. So please take a look, download that if you haven't already. So the 3 top ratios that are commonly used in Fortune 500 companies we're going to talk about today are the current ratio, the quick ratio, and the working capital. And you will see all 3 of those on your Mastermind activity sheet that you downloaded. So the first one is a current ratio. That's very easy. It just takes your current assets, divide by your current liabilities. And okay, so we should back up here and talk about it. We didn't talk about it much in the income statement, or I'm sorry, the balance sheet, but your current assets are those that are not long-term, that are not fixed, I should say. So current assets would be, for example, your cash equivalents, accounts receivable, things like that. Whereas your fixed assets would be things like a building you own that you can't liquidate quickly. And the same thing with your current liabilities. Those would be things that you could collect on quickly, not necessarily long term. That are due in the short term, not necessarily long term. So I'm gonna flip over here and look at the activities worksheet that you're at right now. So we're on page 3 of that, right? So your current ratio, it says the goal of it is to measure short-term liquidity to measure your company's ability to meet its current obligations, right? So bankers, of course, are going to be very interested in that to know whether you're, solvent or not, whether the company can even pay its bills in the short term. Number 2 is the quick ratio, and that is also known as the acid test ratio. It's the same thing as a current ratio, except for you don't include all of the current assets. You just include cash equivalent, and accounts receivable. And then you divide that again by current liabilities. And that, again, is your bottom line of how solvent the company is. Is it going to last in the short term? If you had to go out and liquidate everything and pay all your bills, would you be able to do that? Okay, number 3 is working capital. And working capital is actually not a ratio because it's not a division problem, it's a subtraction problem. So it's your current assets minus your current liabilities, and that one just gives you the availability of net capital on hand, and it indicates your company's ability to grow and fund operations. So again, those are the 3 top that a banker or an investor will want to see, and of course those will be in your Proforma. The other 2 that would probably be helpful to you as a real estate brokerage are debt to equity ratio and your profit margin ratio. So debt to equity is how much you owe versus how much you own. And then the profit margin is, again, that is your total income, your sales, and your net income divided by net sales. So that basically says, earlier we talked about revenue versus, net income. So that's the margin that calculates that. It's the ratio, sorry. Okay, now at the bottom of the slide, we see no inventory, no asset turnover, no accounts payable, no accounts receivable. And you have to admit, real estate brokerages are a fairly simple business. We don't manufacture widgets, so we have no need for inventory, and that eliminates a lot of the financials and the ratios. We don't have turnover of assets. We're not selling physical products. We generally don't have accounts payable or accounts receivable because, it's based on we collect money when we close a transaction, and there's generally no outstanding bills due. If it doesn't close, there's nothing due. So because of that, it makes our financials very, very simple compared to a lot of other businesses. Okay, any questions? Anything? Formulas. So the formulas are included in today's activity worksheet. You're looking hopefully at page 3 there. And if you want more information about financials, I suggest this book by Lita Epstein, The Business Owner's Guide to Reading and Understanding Financial Statements, How to Budget, Forecast, Monitor Cash Flow for Better Decision Making. So you can go ahead and pick her book up. It's available on Amazon, and I think it'd be a great read for anybody who wants to know more about the financials. What do they mean, right? I printed it out in QuickBooks, but I have no idea what it means. And this can help you to make better financial decisions for your brokerage. All right, now we're going to talk about something everybody loves, bank account, right? Because what do we put in the bank account? Money. So now we have a little poll for you, and we're going to go ahead and stop our file sharing and go over to our poll. And our next poll is, how many total bank accounts do you have? Okay, go ahead and take a look at these and choose an answer. And in this one, there is a wrong answer. I hope everybody can identify it. And there's an okay answer, and then there's a good answer. So A is only one bank account, your personal and business combined. B is 2 bank accounts, one for personal one for business. And C is multiple business accounts for your brokerage. And again, that's assuming that you have a separate personal account as well. All right, so it looks like we got 19 people live right now. So we're waiting for a few more answers to see what you say there. And don't forget, you have to have a client trust fund account, not trust fund, but yeah, client trust account for your real estate clients, especially if you're a property manager or if you receive earnest money deposit funds. So, okay, so we've got nobody answered A. Woohoo! Good job, everybody. We don't want personal and business accounts combined, right? Because not necessarily that it's illegal, but if you have a corporation, that could pierce the corporate veil, number one. Number two, it's nearly impossible to do your bookkeeping, your taxes, your accounting. And number three, it's just good business sense, right? So nobody answered A, which is great. We have B. 40% said you have two accounts, one for personal, one for business. So good job. You're on the right track there. And C, 60% said they have multiple business accounts for brokerage. Well, if you're just starting now and you just have two accounts, you're wondering, how does that happen? So let's see how that happens. Okay, so I published the poll there. You should be able to see that. So, client trust accounts. Remember, trust funds do not belong to the brokerage company. They belong to your client. So you have to account for those fiduciary funds. As we know, they are regulated by state law, and in California at least, incorrect, I don't want to say use, but incorrect disposal of clients' trust fund money is a huge problem, and that is probably the number one reason why most licensees get disciplined, get their license suspended or revoked. So we don't want to go there. Make sure that you follow all your state laws. But something very interesting to note, in California, our Department of Real Estate has very specific requirements for a real estate client trust account. And they are so specific that major banks in California do not offer these accounts, right? I won't say any names of major banks, but if you have an account at a major bank, chances are it's not a trust fund as required by the DRE. Now, I'm not sure about other states, but in California, we do have the CAR attorneys who have gone through the trouble of making a list of banks that do offer these accounts. And I'm very thankful for that. They have a good list if you want to contact them, and your state realtor association may have something similar as well. Okay, so let's talk about designated accounts. What are designated accounts? This is not trust fund. This is your own business money. How do you have money to pay taxes quarterly or annually? Do you have money set aside for that? Well, do you remember in the good old days, sometimes people would get paid in cash. They would have some envelopes. They would take their cash and they would put money in each envelope. Here's money to pay the mortgage or the rent. Here's money to pay the car payment. Here's grocery money, and sort of separate that. Well, in this wonderful book called Profit First by Mike M., I'm not sure how to pronounce his last name, but he has a wonderful book. I have it on audio, and he explains a concept called Profit First, where you take your money, your income, and you put it in different bank accounts so you don't accidentally spend it on something else. Number one, paying your taxes. None of us want to be behind with the IRS. Also, what about paying recurring expenses? Monthly versus annually. So here's my little tip on that. If you have expenses that you have to pay, you have a choice between paying them monthly or annually. You need to look at your income. Do you receive monthly income steady every month? If so, it's okay to pay bills monthly. But if you don't, it's probably better to pay it annually or quarterly, You want to pay in the method that coincides with your income so you don't get behind. Okay. So definitely look at your income type, sources, and regularity before agreeing to certain expenses. The worst thing that could happen is agreeing to pay a whole lot of monthly expenses when you don't have guaranteed certain monthly income. Now, one way to solve that very quickly is to start a property management division, because you get paid every single month like clockwork on the 5th of the month or whatever day you set up. So that's the best thing right there is property management can solve some of the cash flow issues of the up and down of sales, of a bunch of closings this month, no closing this month, a bunch and a little, right? So get that book. Awesome. Highly recommended. It's on Amazon. This is an example of a sales corporation. In the sales corporation, they have 2 different types of business accounts. You can see the top is a business funnel or business account where it's going to come in and then go into different categories. And the second is your client trust account. That's in red because that one is your client's money and you don't touch it. You have to have it underneath your corporation because you have to sign on the bank account. But again, it should never be commingled with your business account, your business funds, which are money that are due to your brokerage or due from the brokerage business account. So if you look in your notes there, the worksheet you downloaded, you're going to see, I think it's on page 4 and 5, we have this little diagram for you. And in the book Profit First, Mike talks about having separate accounts for your income, your fixed expenses. These are expenses that happen every month. So out of your income, take the exact amount or approximate amount that you're going to spend every month on your overhead and put it into a separate bank account so that overhead comes out of that bank account. Take your amount that you estimate for taxes, put that in a separate bank account far, far away where you'll not be tempted to touch it, right? A good account is Realtor Federal Credit Union because it's not real easy to get your money out of there, and you can do an automatic online transfer where it goes in, and then when you want to get your money out, you pay quarterlies or pay your taxes at the end of the year when you file. You're going to want to go get that out. What about payroll? You always want to make sure your staff is paid, and most importantly, who else is on payroll? You, right? Your salary. Make sure your salary is accounted for. Don't take the crumbs that are left, but designate that money right up front. Put it in a separate bank account for all your payroll. And that's where you can have an assistant helping you with your payroll. And lastly, our donations. Now, for example, your brokerage has a commitment to the local Habitat for Humanity. You're going to put aside $50 from every sale, or your agents are going to match that, whatever you do. And you're going to put aside money every transaction into a separate bank account. And at the end of the year, you'll have a wonderful donation available to Habitat for Humanity or whatever your favorite charity is. I happen to like Habitat for Humanity because they have a great mission and vision, and they do outstanding work all across the world. Here's another example. This is your property management corporation. Now you're probably asking, why would you have 2 separate corporations? One for your sales, one for your property management. And that's pretty simple. Liability, right? We all know that property management attracts tenants. Tenants sometimes sue you, or more likely, you have to take them to court and evict them. And so you want to have a separate corporation where the liability is not going to interfere with your brokerage business, the sales business. And I would actually even suggest totally different names, because if a tenant doesn't get a house and they're mad, they go on Yelp, write a bad review, it's not going to affect your sales business. Okay, so good idea to keep those 2 separate. Now, in the property management corporation, you have a business account. Through that business account, you're going to have various different accounts, just like we discussed before: income, fixed expenses, taxes, donations, of course, payroll, your salary. And then also you're going to have a client trust account to manage your client's trust funds. Now, if you have clients that own multi-unit properties, say 100 or 200 door apartment complex, you're going to want that in its own trust account. So that's why I have multi-property number 1 in its own trust account. You have another huge multiple property that you manage. You want that in its own trust account. And then you have a bunch of miscellaneous ones with individual owners. So that would be its own trust account. Okay. Does that make sense? Any question? Oh, I see a question here. Can I commission myself and keep the rest as owner's equity? Okay. So what you want to do is you want to pay yourself for your sales. And I actually agree with that. Some people may not, but I do agree that you definitely should make sure that you get paid as an agent if you're doing the agent's work. Not everybody agrees with that philosophy because they say, well, you're the owner. You sort of, everything goes into one big pot. But I find accounting wise, it's easier if you can designate certain accounts. If you could designate and say, here's all the income that did come in from transactions. Otherwise, you really don't know when you run your numbers what came from transactions if you're not designating that separately. And if you're just throwing it all into one big pot, you're not going to have accurate numbers at the end. And you also won't know how much you brought in versus your agents, which I think is a really critical number here. Okay. So any other thoughts on that? I'd welcome it. I hope that answers your question. Next is bookkeeping, accounting, and tax prep. So let's cover this briefly. And we have another little poll for you. And the poll is, which bookkeeping system do you use? So let's put our poll up here. Okay, which bookkeeping system do you use? The choices are A, QuickBooks, whether you use online or desktop version. B, Microsoft Excel, which means you're doing it yourself, right? Or C, other choices. Now, some of us have back office system that may have a bookkeeping system integrated. What I'm finding is that most brokerage back office systems do not have their own built-in bookkeeping system, and they generally integrate with QuickBooks. So, okay, so far we're getting QuickBooks 0%, Microsoft Excel 67, and other 33. Oh, others now 50. If you are using other, can you please put in the chat what your other is so that we can find out what everybody's doing here? Now, Microsoft Excel is a great way to start, but QuickBooks is so inexpensive and it actually saves you a lot of time. My favorite part of QuickBooks is that it automatically pulls from your bank account, right? So you open up QuickBooks, it syncs with your bank account, pulls in all your income and expenses. All you have to do is go through and choose whether it's in the correct category or not. If it's not, just pick the correct category, and then you can push a button, run your numbers, find out everything. So, okay, we'll be implementing QuickBooks and Brokerment. Great job. QuickBooks Online. Okay, great. Let's go back to our poll here, and we're going to go ahead and publish our results. QuickBooks 33%, Microsoft Excel 44%, and other 22%. All right, great job. And with that, we're going to go back. Okay, at the top of the chat window, you can see that we have a link for the QuickBooks training and tax and legal videos. If you go ahead and click on those, you can find out more about those resources available to you. And again, the first link is our mastermind group, which is where we're going to put the replay. We're going to put all of these great tools that we're sharing with you as well, the bonuses, the handouts. All right, bookkeeping and accounting. What is the importance of that? You need to have checks and balances, especially if you have somebody else doing your books. You need to know that they're doing the right thing because you need to have more than one person looking at it. But even if you're doing your own books, isn't it wise to have a professional looking at that as well? Now, when you first set up QuickBooks, you're probably asking yourself, how do I get started? What do I do? QuickBooks is so complex. Well, actually the hardest part is just setting up your chart of accounts at the beginning. So what I have for you today is a sample chart of accounts. Okay, Linda, I see you're using Zoho. I love Zoho. I'm going to share with you right now our sample chart of accounts. So go ahead and download that. This is just to help you get started. If you're wondering what category everything should be in, that should help you see the different categories and get set up with your chart of accounts. Now, again, you don't want to be alone doing this by yourself. Here's what it looks like, by the way. Okay, and that should be available in the download. You can see the bank accounts, the assets, equity, income, cost of goods sold. Well, we don't really have any goods we're selling, but we do have cost of sale, which is our agent commission that we're paying them, right? So I count that as a cost of sale, and it actually is an easier way to calculate than just an ordinary expense. So there's all the different expenses, and they're by category. So who's going to help you set this up? You can set it up yourself if you're great with QuickBooks, or your bookkeeper, right? So how many have a great bookkeeper? If you have a great bookkeeper, accountant, or CPA, tax preparer, you can go ahead and put that in the chat today. So your bookkeeper is somebody who's going to do your day-to-day bookkeeping. And honestly, if you have QuickBooks where it downloads from your bank account, you can have a virtual assistant even help you with that. It's very, very easy. Make sure it's somebody you trust. You might want to even have that person make sure that they're bonded. But again, check and balance. You always have to check, right? What is that saying? Trust but verify. And that is your job, is to oversee the business. Now, your accountant or your CPA is somebody who's going to help advise you as far as your finances. That person may or may not be a tax preparer, because a tax preparer is generally a different category, or an EA, which is an enrolled agent. So you definitely want to make sure that you have somebody who understands small businesses and specifically real estate if possible. Okay, so CPA, okay, good. Yes, I happen to have a CPA who's also tax preparer, EA. She's super awesome and saves me a lot of stress. So, okay, all right, good. Timothy, have a great CPA, about 30 years, couldn't live without her. Okay, awesome. So these are vital members of your team. This is your dream team. Get your dream team, designated. Who's going to be on that team to help take your business to the next level? Now, a little note here. I want to talk about something that is a myth, I guess we could call it. A lot of times we hear in real estate, calculate the break even. We even hear that in big corporations. But I don't want you to think about break even. Why? Because it's not the right mentality. If you're working to break even, you might as well shut down your business and go get a job somewhere, right? The goal is not to break even. Talking about break even point fosters a failure mentality of doing calculations and buying things just to break even. And that's not the goal, right? So our goal is to maximize profitability. Think profits. How much can I earn? And if I'm earning 3% on this, my return on investment, if I were to take that money and do something else with it, would that be a better choice? And we'll talk about that more when we talk about business operations in a couple weeks. So not only should you be earning a profit and a salary, but also there are additional factors to think about: your time, your effort, your stress that went into the business. So you're not doing all this to break even, right? Break even is not the goal. So I don't want you to think about that. It is used sometimes in business for certain reasons, but for us, we're going to focus on maximizing profit, not breaking even. Okay. All right. Last topic is raising funds. How do we get that necessary money that we need to grow our business, expand it, to even start it? right? There's an initial investment, but getting that capital is going to cost us something. And there's generally two ways it can cost you. It can cost you as a debt. So you go to a bank, you get a loan, and then you're paying interest on the loan. Or if you bring on an investor, what's that going to cost you? That's going to cost you a piece of your equity. You're losing equity, right? That could be a venture capitalist. It could be an angel investor. And there's also something that's sort of a combination called debt conversion. And if you watch the Shark Tank and you see Mr. Wonderful with all of his great ideas, that's one of his ideas that he does bring up from time to time. So think about, how are you going to grow? It's all about balancing debt. Do you want to be debt-free, or do you want to have rapid growth? You can't have both, because in order to have rapid growth, it does require capital. And unless you have $250,000 sitting in your bank not doing anything, then you're going to have to raise some funds. And that's going to be a balance between being debt-free versus rapid growth. And that's something that you personally have to make the decision on based on your values and where you want to see the company grow and how comfortable you feel with your skills and what you're putting into the company. So startup capital, those are your initial costs. When you do your business plan and your Pro-Forma, you're going to calculate those, and you'll decide how you're going to structure long-term debt, right? And where are those funds coming from? What is the source? And how will that affect future profitability? So say, for example, you buy a business and you pay the cost to buy the business of maybe the net income is $100,000 a year. And so you pay $300,000 for the business. So what is that telling you? If you continue at the same pace, it's going to take you 3 years of breaking even, right? To be able to start to earn a profit, because you're paying for what you've invested in that. So that's something you have to think about long-term, is how will that affect profitability? We have 3 books for you that we talked about today. The first book we discussed was Profit First. I have it on Audible. I love it. I'm actually going to also get the hard copy and listen to it on Audible again and follow along with the hard copy, because it's so much great information. The second is A Business Owner's Guide to Reading and Understanding Financial Statements. The last one, The Art of Profitability, that book is not for the faint of heart. It is a complex book because it's not as much about profitability as it is about various business models. And when you're ready to think outside the box and be innovative in your brokerage and see what the big corporations are doing that are very, very profitable, that's the book that I would suggest. But to get started, start with Profit First and understanding your financial statements. Again, we do have a tax and legal library available to you, and QuickBooks basic training and QuickBooks. And of course, those links are at the top here. And I thought I'd just throw this in for good measure. When people tell you they want to get into real estate because it's easy money, right? We know that nothing can be farther from the truth. Running a brokerage requires sacrifice, sweat, stress. It's a lot of hard work. We put our agents first. We take care of our responsibilities. It's no longer about us, but it's about offering opportunities to our agents, taking care of them, helping them grow, mentoring them, guiding them, training them. We put our heart and soul into our real estate brokerages. And if we do earn a profit, it is well deserved, right? It's definitely not easy money. Can anybody relate to that? Okay, good. Oh, Marcel, you don't see the links at the top. Okay, I'm going to go ahead and take those links and put them into the chat bar right now. Okay, so there are the 3 links. I just put them in the chat: the mastermind group, the QuickBooks training, and the tax and legal videos. As I mentioned, we have a gift for you, which is our sample chart of accounts. And I think you hopefully were able to download that already, which is great. Lastly, let's talk about the road you're on. How many of us have heard this saying? It's by Lewis Carroll in the Alice in Wonderland book. If you don't know where you're going, any road will get you there. And nothing could be closer to the truth with our finances. If we're just running around making money, but never measuring our finances, never understanding them, never tracking anything, you don't know where you're going, right? Where is the future taking you? And guess what? When the market shifts, you're going to be, wondering what happened. So it's really important. Know where you're going. Make sure you have a plan to get there. So today was the third of 12 steps to build your empire. And we learned about Fortune 500 concepts without the MBA price tag. If there's any questions, please go ahead and type them in. Oh, Marcel says, thank you. Ted, thank you. Linda, LOL. Okay. Mirnosh, LOL. Michelle, in-house with review by CPA. Okay, wonderful. Last week we talked about custom business plan. We'll talk about it just briefly here. Timothy says, oh, thank you, Regina. You rock. I'm a fan. Awesome. Woohoo. You guys rock too, because you're here today and you're making your businesses better. You're elevating to the next level, right? Okay, I'm going to do something a little new. My offers. So, okay, here we have a little offer here. Our basic business plan for brokerages. That's $1,000. It doesn't include any financials, no number crunching, no Proforma. We have a second plan here, which is our advanced business plan. And advanced business plan is $2,500. And that one includes a very thorough narrative as well as sales financials, cash flow financials, and it is very, very detailed. So if you're interested in that, I'll send you a sheet showing everything that's included in that. And the last thing is our advanced with the Pro-Forma, and the advanced business plan with the Pro-Forma is $5,000. With the basic, we have some writers to help us with that, some experienced business plan writers. With the advanced, we have a business plan writers. Besides that, your business plan will be reviewed by an expert, a Shark Tank style expert. And the advanced plus Proforma, you'll have the additional bonus of having somebody who's trained in accounting to be able to go through the Proforma with you. Okay, so if you like any of those, be sure to let us know. And okay. Linda says, awesome, Regina, where were you when I started this journey? Well, Linda, I think we are both on the same journey for a long time, which was figuring all this out ourselves. And really, that was the whole reason I went back for my MBA degree, is I wanted to operate my business at a higher level. I didn't have the tools and skills. I didn't know anybody that could help me. And I figured an MBA degree would give me those tools and skills, which it did. But it also gave me a great idea to share it with all of you, my broker friends, because all of us, especially us indie brokers, we're out there, we're struggling on our own. We don't have the help of a franchise. Sometimes we don't have mentors, or those who are mentors really don't know these high-level things either. Maybe they weren't trained in these Fortune 500 concepts either. Oh, Amanda says, can't wait to see you speak in December at Triple Play. Yay, thank you. Okay, awesome. So yes, December 5th, mark your calendars for those on the East Coast. I will be at Triple Play in Atlantic City, New Jersey. The two topics I will be teaching, this will be one, start your brokerage. It'll be condensed down to about an hour. And the second topic will be the blue ocean strategy. So it'll be about innovation. I'm really excited about that. Now, stay tuned next week. Our topic is product mix. Right? What different products are you going to offer or services, and how much revenue are you going to expect from each of those each week? So again, we're going to be offering next year, some mastermind sessions on driving up profits and on innovation with a blue ocean strategy, and that's going to be my topic in Atlantic City. We offer consultations to real estate brokers starting out, for those who want to rev up their business or those who just are doing good, but they want to do great and discover innovative new markets. So those, you can always contact me. And that was step 3, finances. Now we have a question here from Marcel. Do you have links for the first 2 sessions? Marcel, thank you for asking. Those 2 links have expired. What happens is when each new session starts, that the previous link expires, so it's only good for 1 week. However, many have been asking me for that. So what I plan to do is to go into Webinar Jam, which is where this is hosted, and to pull down each of the sessions. And I'm going to have a separate website where I make all of the videos available. So watch for that coming soon. When we get that set up, we'll be sure to let everybody know. And we'll let you know through the Facebook group, the Mastermind Facebook group. That's where I think we're going to post things instead of sending out so many emails. That way you don't get bombarded with emails. You can just go in there and check for the bonuses or replays and things. So Jonathan says, thanks, Regina. Hey, Jonathan, it was great to meet you last night at the NAREB dinner. That was wonderful. And Michelle says, thank you so much. We'll be in touch. Karen Taylor says, thank you. You're welcome. Thank you. And Linda, great. Okay, wonderful. That is all we have for you today. We went a few minutes over. I hope it was worth everybody's time. Again, we will have a replay of this, so if you missed it, don't worry. Just stay tuned to the replay. Happy, wealthy, winning Wednesday, everybody. Talk to you later. Bye. Sukita, bye. Thank you. You're welcome.